right? So in this context, where should you ideally park your money to optimize your after-tax returns in terms of your investments? Right? So we look at a few options, right? So one of the key products that we are talking about here is what you call the unit trust fund, right? I'm sure most of you would have heard about the unit trust, but let me explain what a unit trust is before we look at that, how you can effectively manage it in terms of taxes. Okay? So what a unit trust basically means is that the unit trust fund manager, for example, CAL Investments is a unit trust manager. It collects a pool of funds from multiple investors. It can be thousands of investors who are even giving 100 rupees of investment, right? So we pool investments from multiple investors, right? And then put that into a particular, we create a fund for that particular set of investors, right? And that set of funds will be invested in multiple products. So in this particular case, if you look at on the left-hand side, there's, say, for example, you collected 1 billion rupees as total investments from individual investors, right? And that 1 billion investment, what the unit trust manager is doing is breaking it down into investing in company A, company B, company C, and also investing part of it in treasury bills. This is a hypothetical example that we put in. Right? So investment A is making 15%, investment B is making 23%, investment C at 20%, and investment D, which is on T-bills, is making 24% return. The weighted average return, if you put all these together, is 19.5%, right? So this 19.5% return, right, on this 1 billion, say for 1 billion of pool of investments, will make roughly about 195 million rupees of total return, right? So based on the individual investors' proportion of the investment, say for example, if someone had only invested 10 million rupees out of the 1 billion pool, he will be liable for 1% of the return made by the particular portfolio, right? So this portfolio return will be apportioned among the individual investors based on the amount that they have invested in the particular fund. Right? So that's the concept of a unit trust fund. Right? And the benefit of a unit trust fund is that you can even start small. And it's invested in a pool of assets like what I've showed here. We've shown four types of assets that we've invested the portfolio in. And also it's in most of the cases, it's a money market instrument, which means that you can use it almost like a savings deposit, right? So if you invest today, you can even withdraw the money tomorrow, right? So it's an alternative to a savings deposit, right? And the good thing is that there are professional managers who are managing the money for you. They will figure out what is the effective instrument to invest in. They know when to time the interest rates, when to go long, when to lock in the rates, right? So that helps you to effectively manage money better than you individually making the call of investing, whether to park it in a short-term instrument or whether you want to go long. That decision will be made by the fund manager itself, right? And also it's regulated by the SEC, Securities Exchange Commission of Sri Lanka, and also all the funds which come into the fund doesn't come into the unit trust management company. For example, in the case of CAL Investments, for example, if you're investing in a unit trust fund, you will channel the money through a custodian account or trustee who is Deutsche Bank. Okay? So Deutsche Bank will handle the entire money. So the money that you're investing doesn't come into CAL Investment per se. It is waiting in a different entity altogether, which is monitored by SEC and also by a custodian who's handling all the transactions for us, right? Which is giving an additional safety cushion. So this is just to give an idea of what a unit trust before we look at how we can use a unit trust to effectively manage our investments, right? So as I mentioned before, there is a very high possibility, right, that your income tax rates can be reduced in 2-3 years time, right? And also keep in mind that when different political regimes come into play, there is a different view on taxes, right? So if they feel that the tax rates are high, that can also be a reason why they will kind of reduce the rates, right? So if we feel, and based on what we think, if the tax rates come down to 24% in 3-4 years time, what can we do? How can we capitalize on that? So I'm showing you 2 examples here, right? The one on the top is a traditional bank deposit. Right? If you invest 20 million rupees in a bank deposit, and let's say, for example, the interest rate is at 25%, how are we going to kind of pay the taxes? Right? Let's assume that the total tax liability is at your personal tax rate of 36%. So if you're having a 20 million rupee deposit at 25% interest rate, you're making a 5 million rupee interest a year, which means that effectively you have to pay 36% tax rate on that return. Right? So on the 5 million interest, you will be paying 1.8 million tax. It's 5 million into 36%. That is your tax liability. So we are comparing this return against a fixed income unit trust. Right? As I mentioned to you before, the concept is that you have to only pay taxes if you realize the returns. Right? For example, in case of a bank deposit, if you take the interest at the end of the year or even during the month, you have to declare that particular component as interest and pay tax on it. But let's say, for example, if it's a 5-year deposit where the interest is only coming at the maturity, right? You only have to pay the taxes at the point of maturity. Right? You will pay the taxes for the 5 years, but only at maturity. Right? So you're postponing the payment of taxes. Right? And what will happen is the tax rate that will be applicable will be the tax that applies at that particular time. Right? Say, for example, if the tax regime changes in 2-3 years' time and it falls back to the 24-25% kind of levels in year 2, year 3, it doesn't matter what kind of tax rates apply during this particular period, what applies right now. What matters is what is the tax rate that will be applied in 3-4 years' time. Right? The tax on that day is what you will pay on your interest income. Right? So you're basically postponing your tax payment. So if you don't take your interest out every month or every year, right, you can push back the interest payment, not that tax payment, not that you are not going to pay taxes, but you're going to pay that tax on a future date. So there is a time value of money impact that will kind of come and hit you, right, which is beneficial, right? So in our first example, we've looked at a 20 million rupee deposit, right? Assume a 25% interest rate, which means that you will make 20 million into 25%, 5 million rupee interest per annum. And out of that, if you are taking interest out, the 5 million in cash every year, you will pay 1.8 million in taxes. That is 5 million into 36%. So at the end of year 1, that 20 million will become 23.2 million. Why? Because 20 million, the 5 million interest gets added to it, and the 1.8 million gets deducted as taxes. So you will end up with a capital of 23.2 million, right? And this exercise goes on and on, right? So you're paying the 36% tax rate for 5 years in this particular case. I've taken a 5-year example here, right? And at the end of the period, the capital that you get back after paying all the taxes on a yearly basis will be 42 million. The capital that you get back will be 42 million, right? So let's say we use the fixed income unit trust route, right? Now, for example, you will have a certain component of your money, which is normally investment, which you don't use for day-to-day use. Right? You're okay to put it away for future use, right? Future investments and so on. So if you have a component of investment which you're not going to touch, right? And if you don't need that particular interest income on a monthly annual basis, postpone it. Don't take it now, right? And fixed income unit trust fund helps you do it, because what happens is the interest gets accrued on the fund on a daily basis. Right? So unless you go and withdraw and take the interest out, the interest just gets accrued in the unit trust fund, right? So if you had invested $1 million, say in 20 million in this particular case, and let's assume the same 25% interest rate applies. On the first 5 million interest, because we are not withdrawing the money out, you don't have to pay taxes on that particular year, right? So you're not taking interest as cash on that particular year. So 0 tax is paid in year 1, right? So what is happening is 20 million is earning a 5 million interest at 25%, no taxes paid. So your capital asset year 1 becomes 25 million, right? And same thing, it continues where you're not paying taxes because you're not taking the interest out as cash, right? But what we are doing is in year 5, right? Say political regimes change and the tax rate comes down. if the tax rate comes down to 24% in that particular year, what we are going to do is on all the interest that was accrued over the last 4 or 5 years, we are going to only pay 24% in year 5, right? So first few years, we are not paying taxes at all. In year 5, we are paying the lower tax. Right? So effectively, you're only paying 24% tax, and also you postponed your tax payments, which has saved you a bit of money, which is basically earning you interest, right? So by doing that, your effective tax rate reduces substantially, right? So same case, if you had invested 20 million rupees in a bank, at the end of 5 years, your return would have been 42 million, or your capital would have been 42 million. If you had parked the same in a unit trust fund for 20 million, right, and not paid taxes because you're not taking withdrawing the cash, right? And at the end of year 5, when taxes reduce to 24%, right, if you take the money out, your capital will be 51.2 million versus 42 million that you will get on a bank deposit, right? So the trick that we are doing here is we are postponing the realization of interest. So if you have excess investment where you don't need that interest income to run on day-to-day basis, don't realize that into your income, postpone it. And the best channel to use for postponing your interest returns are the fixed income unit trusts, because the interest accrues and that interest is also earning interest, right? So you can keep postponing your returns using a unit trust fund, right? So this is a scenario if taxes are coming down in 2-3 years time, right? But let's say, for example, even if the tax rates are expected to stay at the same 36% rates at the current level, right? In year 5, no change in taxes, it's the same. What is happening is the bank where you're putting 20 million will obviously be 42 million in year 5, right? But even if you assume that the 36% tax is going to stay, right? The 20 million return, the investment that you're making, the fixed income unit trust, will only have to pay tax of 36% in year 5, right? So basically what is happening is you're not paying interest on that particular year. You're postponing that interest. That interest, that tax component is being reinvested in the fund, right? And that's also earning an interest, right? By doing that in year 5, right, your capital will be 46.2 million, still way greater than what you would earn on a bank deposit, right? So what we are doing is we are postponing the taxes, because the taxes are only applicable when you realize the income from your investments, right? So even if you do it on a bank deposit, you go for a longer term FD, for example, like a 5-year FD or so, because if the interest is coming at maturity, you only have to pay interest at that particular tax at that particular time. But obviously, banks won't offer you a great return if it's a longer term product, because their normal products are 3-6-12, where they give the highest return to, right? And banks would obviously not want to lock in at these particular rates. So the unit trusts are one effective way how you can effectively reduce your tax liability if you keep postponing. Just give me a second. So the other asset class which can be used as an effective instrument to manage taxes are treasury bonds, right? So in terms of treasury bonds, you obviously have something called a yield to maturity, or the yield, or the return that you get on the bond, and what you call a coupon, right? Coupon is the cash that you actually get to your example. If a bond has a face value of 10, only have to pay taxes or personal billions. Right? So where you right? So at that particular point, treasury bond, initially you only hello, can you hear me now? I hope the connection is clear. Hello. Okay. So I was explaining on taxes in terms of treasury bonds. So in terms of treasury bonds, as I mentioned, you only have to pay taxes on the coupon rate, right? And not on the yield to maturity, right? So in the initial years, you're only getting the coupons as cash to your hand. And as I mentioned, only during the realization of the coupon, you have to pay taxes, or realization of your interest, you have to pay taxes. Right? And the discount you only get at the end of the period, end of the maturity, right? So you're postponing the tax that you need to pay to the maturity period, right? So effectively, the tax that you're paying is less than what you would pay on a typical bank deposit or so. So since taxes are only supposed to be paid at the point of realization of interest, the personal income tax will only have to be paid on the coupon in the initial years, right? And the tax on the discount, which is the difference between the face value and the investment amount, only needs to be paid at maturity, right? So that's a postponed amount that we're doing, right? So if you look at the example here, we are looking at if you look at the numbers below, the face value of the bond is 20 million rupees. Investment is 14.1, which is the money that you're putting right now. And yield to maturity is 20%, and the coupon is 10%, right? So basically, the price, you're only paying 14 million to buy a 20 million rupee bond, right? So the return, so you pay, so every year you will get 2 million to your hand, because on the 20 million rupee face value, right, you get a coupon of 2 million rupees. Right? On that, you will pay 36% if you're falling into that 36% tax bracket. you will pay that particular tax on that 2 million every year, right? But in the last year, right, you have to pay for the discount component, right, which is the difference between the 20 million and the 14.1 million, which is a 5.9 million discount. Okay? So you only pay the tax on the discount at the maturity period. Right? So basically, the tax on the discount is postponed for a period of time, right? And that will effectively save you a bit of money in terms of the taxes that you have to pay. And especially if you are expecting taxes are going to come down in 3-4 years' time, right? It is better to buy a bond which is trading at a deep discount, right? When you say deep discount, when the bond has a lower coupon compared to the current yield of the market. So even if you look at the current market context right now, the yield of the market is about 25-27%, but coupon rate is only about 18%. Right? So you only have to pay taxes on the 18% right now and not on the entire 27-28%. So this is another way that you can effectively manage your taxes. Right? The other good thing is that if interest rates come down, you obviously know that bonds will make a capital gain. Right? So on the capital gain component, as we mentioned before, capital gains are only subject to a 10% capital gains tax. Okay? So if interest rates come down and you make a gain on the bond, right, you will only have to pay 10% capital gain tax without paying a 36% tax rate. Right? So on bond gains, now if you look at the last couple of weeks, bond rates have been coming down. So for example, the 3-month Treasury bill, for example, which was at 33%, is now almost at about 28-29%, right, in the primary markets, right? So with rates coming down, if you had bought a bill or a bond before, your price of the bond has gone up and you have made a capital gain. So if you decide to sell the bond or bill now, on that capital gain, you only have to pay a 10% capital gains tax, right? You don't have to pay a 36% rate, your personal income tax rate, because this is a capital gain component, right? So bonds have two benefits. One is that you're postponing your tax on the coupon, or tax on the discount, and only paying on the coupon. Second is that if interest rates come down and there is a capital gain, right, you only have to pay the capital gain tax of 10% rather than the personal income tax rate of 36%, right? And finally, the other investment asset class, which at the moment is completely exempt from personal income tax as well as WHT and capital gain tax, is equities or listed shares or investing in the stock market, right? So you can sometimes replicate the returns that you're making on a fixed income product by investing in equities in a share which is giving a higher dividend as well. For example, companies like Ceylon Tobacco, Chevron Lubricants are very high dividend yielding companies. For example, they pay roughly about 90-95% of their profits as dividend, right? So if you look at the last 2 years, they have not been doing so because they've been unable to take the money out or the profits out as dividend because of currency issues. Now with currency improving or FX flows improving, they should be able to declare dividends and take them out. Okay? So you will see these companies reverting back to their higher dividend rates, right? And if you look at the current share price, a lot of these companies like Ceylon Tobacco, Chevron, can give you between 20-21% return gross of any taxes. Okay? So it's almost like a fixed income product, right? You're going to get that dividend. You're going to get somewhere between 15-20% kind of return, right? Just like a fixed income instrument, but in the form of dividends, right? The good thing is that when it comes to dividends, you only have to pay a 15% tax liability, right? So dividends will only be taxed at 15% compared to you be paying 36% as personal income tax in your file. Right? So if we take an example, say Ceylon Tobacco as an example, roughly we are looking at about 120 rupees a share as dividend for next year, which converts into a yield, right, of 21%. So if you invest 600 rupees as a share, you get 120 rupees as a dividend, right? And on that, you will only effectively pay 15% tax, right? Which will mean that your after-tax return is going to be 18%, right? If you look at a similar scenario, if we go with a bank deposit, the current rates that you're looking at on published rates on the websites are somewhere around 17-18%. Right? But on the 17-18%, if you're falling into the high income tax bracket, you will be paying 36%. Right? Effectively, which means that you will only end up with 11% return on your bank deposit. So even if you're investing in 17%, if you're crossing that 308,000 rupee total income for a month, you're going to be paying 36% even on your fixed deposit, right? Which effectively means that even if you are investing in 17% return, the net return that you're getting to your hand is 11%. If you are properly filing your taxes and so on, you will only get 11% to your hand. So what we are saying is using equities, companies which have a higher dividend yield, as an alternative to a bank fixed deposit. Since there are few companies which are giving a higher dividend yield, you can use that as a channel to effectively reduce your tax liabilities, because dividends are only going to be taxed at 15% compared to bank deposits, which can be taxed at a higher rate of 36% if you are falling into a monthly income, total income of 308,000 rupees or more. Right? So now going forward, whether it doesn't matter whether it's employment income or interest income, everything will be put together and taken as total income. So if your total income, inclusive of all kinds of income that you make, crosses 308,000 rupees a month, you will be falling into that 36% tax bracket. Right? And it's a progressive rate, so you start from 6% going up to 36% in terms of your return. Right? So we are suggesting using the share market, investing in high dividend yielding stocks as an alternative to a fixed deposit, which is giving kind of similar kind of return, or you're getting a better return compared to a bank deposit in this particular case. Right? And also equities has an added benefit, because this is only we're talking about dividend returns here. Capital gains, if the share price goes up, that gain is entirely tax-free, because your capital gains tax on equities are completely tax-free. So in terms of capital gain taxes, equities are completely exempt. It doesn't fall into your 10% tax bracket as such. Right? So equities is a perfect tax exempt product for you right now, because you don't have to pay. If you're falling into the higher bracket, I would highly recommend you have a portion of equities, right? And look at companies which are stable and can pay a higher dividend, because you can avoid paying that higher 36%, but pay a smaller 14% as dividend taxes. And on the capital return or the capital gain, you don't have to pay any tax at all. Okay? So these three products, unit trust, bonds, and thirdly the equities as an option, are the best tax efficient products available in the market right now. Right? Every other product, bank deposits and so on, if you're taking interest every year to your hand, you're going to be taxed at those respective tax brackets. Right?